Okay, I have already explained to you what the mutual funds are, a brief description in the mutual fund part 1. Okay, now whenever you buy a mutual funds, the mutual funds comes with the load options. Remember that thing. Now, what are these load options? You may be thinking. Okay, load options are something where you have to pay a commission to the salesperson whenever you are buying a mutual fund. Now, mutual fund has a little bit different type of the load options. There are four different types of load options. Okay, first there is no load, means in the mutual funds there is no commission charges paid on the sales. No load funds will include other fees like purchase fees, redemption fees, exchange fees, account fees. It will also have the operating expenses included, but it will show you no. It will tell you that it's a load mutual fund. Remember the thing, but that doesn't mean that there are no expenses and no fees included into it. No load only specifies that no sales commission paid. Then there's a front end or the initial sales charges ISC. Commission is charged when the sales takes place, so that buyers will have to pay the commission also. Whenever you are going for purchasing a mutual fund, if it is a front end load fund, remember that thing, you will have to pay the commission for the sales. That would be a small fraction of percentage, but still you have to pay that thing depending from the fund to fund. Okay, now if the organization says it is a no load fund and you don't have to pay, well and good, but mostly you will find that there is a certain small percentage is usually paid, that is initially charges are paid to the sales or the broker, the person who is a broker. Okay, then there is a back end load or the deferred sales charges. In this case, the investor would pay the charges to the on the condition it sells before the certain period of time. This amount may decrease with every year gone by. What it means that whenever you sell the mutual fund, you may have to pay a certain charges to the broker. Condition apply that if you sell it within a certain period of time, only then. Suppose it is for the 5 years, then if up till 5 years, if you sell it, then the certain percentage you may have to there would be a certain sales charges applicable to it. If you sell it after 5 years, there may be a sales charges of zero, but every year the sales charges keep on declining. Okay, this is only to keep the mutual fund investors into the net, because they don't want people changing so fast. Low load, similar to the back end load, it is very similar, there is hardly any difference. Okay, now let's move to the profit part of it. Profit from the mutual fund. Now, where does the profit comes from the into the mutual funds? Now, the mutual funds makes a profit from dividends, interest, and by selling the securities. What does that mean? Is that a mutual funds, whenever they have invested your money into the different securities, these securities generated dividends, and if they have invested into the bonds, that they generate interest. Okay, all these things actually generate a type of income. Then by selling the securities, what happens is certain stocks may be actually shoot up in the price on the stock market. Okay, and the mutual fund manager may decide to sell off the securities and then again may think to rebuy at a lower rate in the future, or may like to diversify their sell that particular stock and buy a reinvest in some other stock which is available at a cheaper rate and which they expect to go up. This is how they make profit. Okay, so dividends, interest, and selling of the securities. Now remember, whenever there is a profit made from the selling of the securities, there is a capital gain tax applicable to it, and for the dividends and the interest there would be a tax of a regular income that would be applicable to it, because they would be actually distributed to the investors. Whenever they are distributed to investors, it will be taxed as a regular income. Okay, profits are paid to the investor through the distribution. As I already explained, profits would be paid to the investor through the distribution. Income distributions are based on the profit from the dividend and the interest. This is the income distribution that is made quarterly. Okay, they may give you quarterly distribution of whatever the profit is, and a dividend, and or maybe yearly, depending upon maybe 6 months, whatever it is. It may be giving you the profit away every 3 months or sometimes. Okay, that's known as the income distribution are based upon the profits from dividend and interest, not from the capital gains. Mind you, the capital gain would be distributed only once a year. Okay, income is distributed quarterly while the capital distribution is paid only once a year, usually in the December. Okay, it can be any other month also, it depending upon the organization to organization. Instead of receiving distribution, profit may be reinvested, but the investor may pay tax on the profit whether it is distributed or reinvested. Now this is the funny part of it, whether you invest it back to the in the mutual fund or whether it is distributed to the mutual fund's owner, the profit is still taxed. Remember that thing, it will be still be taxed, you have to still pay the tax. It doesn't make whether any difference whether it is being reinvested or whether it is being actually distributed to the mutual fund investors. Income distribution are taxed as ordinary income while the capital distribution are taxed as capital gains. Now whatever income that is that given you as a dividends or this thing is distributed every quarterly, okay, that would be taxed as a regular income or ordinary income, and while the capital distribution that is done once a year would be actually taxed as a capital gains. Capital distribution is the money that is generated from selling of the securities. Now each fund has a predetermined investment objectives that tailors the fund assets, regions of the investment and investment strategies. At a fundamental level, there are three varieties of the mutual fund: equity fund, fixed income, money market. Now equity fund are stocks, fixed income funds are bonds, money market funds. These are three ways how the mutual funds are diversified. All mutual funds are a variation of these asset classes. Okay, now let's move further. Again, it is the same thing. Again, it is being said that the different types of mutual fund. All mutual funds are the variation of three main assets: equities, fixed income, money market. Okay, what are equity funds? These are called equity funds because they are invested in stocks. What stocks means shares in the stock market. These funds may concentrate on small cap stocks, mid cap stocks, or large cap stocks, or the combination of them, while the other may focus on the country or sector such as IT sector. Equity funds main objective is capital appreciation and growth. Because of the diversity, some will focus on the income as well. The equity funds always focuses on the appreciation of the share, remember, of the stock. Okay, it is looking towards the company's growth, it is looking towards the stock's growth. That's where it will make the money, that is where the capital would be actually generated, that is where it will make the capital gains, and that is what it distributes to you every year, of course after deducting all the expenses and other things. Let's move to the next. Now fixed income funds, these funds focus on the stability of the income rather than the growth. They are actually morely like a conservative type of investments in the rather than equities, which are actually may actually fluctuate up and down. This will actually give you a fixed rate of return. It depends upon the bonds it investment is done. For example, return bonds would be riskier rather than the government, which may not give you a high return. Okay, but the government bond may be safer. Now there are the money market funds. Of all the three funds, this offers the lowest risk to the investor. The underlying investment are combined with a short-term depth, which provides a minimal return of the high safety levels, but with a high safety levels. Okay, this is another money market funds. It will give you a very low return, but it will give you a very high level of safety. Okay, that's it. Now in the next video I will discuss the types of the mutual funds. Okay, I'll end it here.